Nike just reported their Q4 earnings and everything, including revenues, gross margins, gross profit, even bottom line earnings, were an absolute disaster. They fell off the map, yet the stock is soaring more than 10% in the after hours. We'll look to answer why that is in this video, and a lot of it has to do with the expectations this company had coming into this print, along with the expectations this company had for the upcoming quarters. We'll discuss all of those things in this video. We'll go through some of their news releases, along with the outlook this company provides on their earnings call, which I did take a listen to, and then we'll walk through all of their different divisional revenues and brace yourself. I mean, things are looking real ugly over at Nike, but perhaps they did give you the signal or the sign that this was the bottoming of their business and maybe the uptrend continues from here. And speaking of uptrend, that's exactly what the stock is doing. In the after hours, you're seeing shares move up over 10%, up to nearly $69 a share. Hey guys, hope you're doing well out there. It's been a tough year, tough couple of years if you've been holding shares of Nike, as you're down about 35% over the past 1 year. Year to date, you're down about 17.5% as well. You do get a forward yield on this, about 2.5%. So you are getting a bit of a reason to continue to hold shares of Nike, and especially in the after hours, that 10% gain is easing up some of your year-to-date losses. Now, it's been a tough couple of years over at Nike, and perhaps no quarter was more tough than this, especially for their business, as you had revenues declining about 12% year over year, coming at $11.1 billion. That did beat expectations, though, on Wall Street by about $380 million. That's not a relatively small beat over at Nike, especially when you're putting up revenues about $11 billion. A $380 million beat certainly is meaningful. Again, tells you where the expectations were coming into this print. I mean, the revenue estimates were closer to $10.72 billion. Some were as low as $10.55 billion. And then even the most bullish analysts on Wall Street were just a shade over $11 billion. Nike coming in at 11.1. So again, beating out those estimates from pretty much all angles in this most recent Q4. On top of that, we'll take a look at the guidance this company provided on the Q1, or pardon me, for the Q1, and spoiler alert, it did come in better than anticipated as well. Now, in the most recent quarter, I mean, things were not looking good. Apart from your revenues declining, you also had your profits just absolutely fall off a map, just 14 cents in the most recent quarter. I mean, this company basically ran Nike Incorporated at break even in the most recent quarter, and we'll take a look at that when we jump into their P&L statement. But full year revenues also, considering this was Nike's Q4, so they did close off their fiscal 2025. Full year revenues coming in at $46.3 billion. That was also down 10% year over year. When you strip out some foreign exchange fluctuations, down about 9%. So this most recent Q4 was particularly challenging. You had your revenues decline faster than you did for the full year. In terms of Nike Direct, this is basically Nike selling to their consumer through their own channels. Think Nike Digital, also think their flagship stores. In the fourth quarter, revenues were down about 14%, coming in at $4.4 billion. On the wholesale side, this is Nike selling to the consumer through their wholesale partners. So think Dick's Sporting Goods, also JD Sports, and maybe even Costco, things like that come into this mix. That came in about $6.4 billion, down roughly 9% as well. This makes up the vast majority of their revenues, considering Nike and consumers still tend to get Nike products through their wholesale partners like a Foot Locker and all those things. They did see a smaller decline in that business, which is a good sign, considering for the past couple of years, Nike was really kicking their wholesale partners, wholesale retailers to the curb and trying to push for more Nike Direct, trying to basically cut out that middleman and gain that margin. As we saw, that clearly hasn't worked out over at Nike, so they're trying to work their way back in with those wholesale partners, at least proving to be a bit challenging. But you do have a new CEO, Elliot Hill, who's been at the helm for about 8 months now. He has a really good relationship with those wholesale partners, and that is coming back into the mix. Now, as we look ahead for the next couple of quarters, I mean, things aren't looking that great. You are beginning to turn around in terms of a declining of your revenue. So this most recent quarter, you saw that revenue decline about 12%, again, coming in better than expected. And then also, as you look ahead for the next couple of quarters, the revenue declines are expected to at least moderate. And then in the back half of fiscal 2026, which is basically calendar year 2026, the start of that would also, you're expecting to see some moderate revenue growth as well. I wouldn't have ultra high hopes for seeing very big amounts of revenue growth, but certainly if this company can stop the bleeding on the revenue side, that can be absolutely a great sign for turning this business around. They kept mentioning on the conference call that certainly turning around a business like Nike wouldn't happen overnight. In fact, it wouldn't even happen in the matter of a year. It will absolutely take time, But once that turnaround does happen, they certainly believe they have the building blocks in place to once again continue to be a growth company. At the end of the day, when you hit up Nike's investor relations page, you see that thing as you hit enter is that Nike is a growth company. Now, they did delay the launch of their highly anticipated Kim Kardashian collaboration. This is, I think, part of their upcoming brand called Nike Skims, which was set to release in spring of this year. And now that, due to production delays, is being delayed to sometime later on in the year, likely near maybe the holiday time period, would be good for Nike to launch this, because considering this is their competitor or their competition to brands like Lululemon, also like Vuori, more so on the athleisure, on the yoga sort of athletic apparel side of their business, which again has been struggling certainly as well. And as competition has heated up in the space, Nike has really fallen flat on their face. They've fallen behind to their competitors like Alo, like Vuori, even like Lululemon to a certain extent, in at least the athleisure space, and especially catering towards their female demographic. So certainly if they have more delays like this, well, that's not a good sign, considering this was a highly anticipated launch. And likely if they can do the production right for this, also in my opinion the marketing right for this, I think this can be a really, really successful launch for Nike, breaking into the space, adding some competition to companies like Lululemon and Vuori as well. Now, I did take a listen to the earnings call and I did post my thoughts from that Q4 earnings call. Like we saw in this most recent quarter, revenues down about 12%. You also had gross margins decline about 440 basis points, which is just a fancy way of saying 4.4%. And you also had full year revenues down about 10%. We'll talk a lot about this gross margin. There's a lot that falls behind that 440 basis point decline. Now, they started off by mentioning that the inventory levels remain relatively elevated. We'll take a look at that when we get to Nike's balance sheet, but they are on track to continue to move through that excess inventory. They're aggressively moving through their legacy and more traditional sort of brands and less innovative brands like the Air Force Ones, the Dunks, also the Air Jordan ones. They're continuing to try to move through excess inventory they have sitting there. And so you're seeing heavy discounts on that side, and that is hurting your gross margins. That's why you're seeing a largely 440 basis point decline on your gross margin. The other thing they mentioned is on the digital side, that Nike Digital is planning to return back to a premium full price model. So that's good to see. Over the past number of years with John Donahoe at the helm, because Nike was kicking their wholesale customers, or pardon me, wholesale partners to the curb, what they were doing is offering huge discounts on the Nike Digital site in order to get consumers to continue to buy from Nike Digital, continue to buy directly from Nike Digital. But again, that had a short-term benefit where you saw higher traffic through Nike Digital and Nike Direct. But now as those consumers leave Nike Direct and they once again return back to their wholesale customers, well, they're not seeing those Nike products on the shelf once again. And so this company now having to turn back on that, once again raise Nike Digital to its premium full price model, which I think is a good thing. You better see more discounts through their wholesale partners, and if you try to go through Nike Direct, it'll be a more premium sort of full price model experience. And again, they're getting back to their wholesale partners, which include Dick's, JD, Urban Outfitters, also Aritzia, and then later in the year, in the fall time, they're gonna once again get back on Amazon as well. They pulled back from that relationship a number of years ago. They're once again gonna begin to sell apparel, basketball, running, those sort of things on Amazon as well. And again, the Amazon customer base certainly is extremely large. If they can get good favorable mix in Amazon as well, that can be a bullish sign. Probably won't be meaningful anytime in fiscal 2026, but certainly if that relationship continues to expand and stay strong, you probably have meaningful sales coming through Amazon later on, maybe in fiscal 2027. Now, they were asked a number of questions regarding tariffs, and as it relates to tariffs, management had a few points highlighting how they plan to mitigate and really anticipate the increase of tariffs and how that affects their business. So the first thing they'll do is allocate production differently. Roughly about 16% of the footwear right now that they import into the US comes out of China. They plan to move that down to the high single digits because we know China and US certainly don't have a great relationship. That's where you're seeing the vast majority of the increased tariffs go to. And so if they can move production out of China, they didn't specify exactly where. And my guess is it would still be somewhere in Asia. Maybe it would move to India, maybe Vietnam, maybe Cambodia, things like that. I'm guessing they're likely to move out of China to avoid that high tariffs. They'll still be tariffed on products coming into the US, and they'll likely still keep production mostly outside of the US simply because it's pretty unaffordable to make a pair of Nike sneakers over in the US. It also takes a long time to get those factories set up, but it's certainly good to see that they're diversifying their footprint, at least their production footprint, out of China, and that'll come down to the high single digits. They're also partnering with their suppliers and their retailers, likely to offer maybe more discounts from their suppliers, maybe if they're ordering larger quantities, and also being able to negotiate better prices from their suppliers, considering Nike is probably one of their best partners as well. That will come into effect sometime in fiscal 2026 at different times, so you'll feel the effects of that slightly differently. And then they're also planning price increases coming into the fall of 2025, so that'll be around fiscal Q2 of their fiscal 2026. You won't see it in this most recent, in this upcoming quarter, but as you head into Q2, you'll probably start to feel a bit of that price increases over at Nike, and then also controlling costs on their corporate side. They'll continue to spend certainly heavily on product sales and marketing, but as you get into general administrative, they'll try to pull back spending there, reducing some costs. And speaking of tariffs, they'll also be impacted roughly by about $1 billion in terms of gross cost increases, and they'll take a roughly 75 basis point hit to their gross margins. That's for the full year regarding tariffs. So that's actually not as bad as I would have anticipated. They did mention in the first half of the year that gross margin hit would be a bit more, and then as you ease off into the second half of the year, it should ease up a little bit. But all in all, for the full year, a 75 basis point hit to the gross margins due to increased tariffs certainly is actually not that bad over at Nike. Now, they did provide Q1 guidance, and this is really where the shares popped about 5% after they provided this Q1 guide. So they anticipate Q1 revenues to be down about mid-single digits. Now, the estimates on Wall Street were for Q1 revenues to decline about high single digits, think about 8% as well. And so considering the fact that Nike is seeing the revenues down just about mid-single digits, does provide a little bit of comfort to investors, considering that you had revenues decline about 12% in the most recent quarter. You're now expecting those revenues to decline somewhere around 5 to 6% in the upcoming quarter. So again, better than feared results over at Nike. In terms of the gross margins, those are expected to continue to decline about 350, call it, to 425 basis points. And of that 425, about 100 basis point impact is going to be straight from tariffs. So if you strip out that tariff impact, still you'd expect about 250 to, call it, 325 basis point impact from just their declining business. Again, that's trying to move through excess inventory. That's also moving away from Nike Digital and trying to get back into Nike Wholesale, which naturally will be slightly lower margin as you have that wholesale partner also eating up some of the margin in there. So you do have a number of factors. Some, of course, are Nike induced, but you also have factors outside of their control, like the impact from tariffs that will impact their gross margins pretty significantly. And then SG&A expenses are expected to be up low single digits. Majority of that is due to the fact that you have demand creation expense, which is, in my opinion, really the moat over at Nike that continues to increase. This company continues to, in my opinion, rightfully believe that spending more on marketing and demand creation is the way to go over at Nike. It's something they can do that no other company that's really competing with them can. And then on the gross margin side, they did mention that margins will remain under pressure in the first half, but they will moderate sometime in the second half. You still probably won't expect any growth on that margin side, but maybe the declines will moderate instead of having 3 to 4 percentage points declining on your gross margin. And then, like I said, some of those headwinds are absolutely Nike induced, like the product mix and the channel mix, but you have some that are out of their control, like the tariffs, also like the macroeconomic environment as well. So overall, things over at Nike certainly didn't look great in this most recent quarter. They also probably won't look great throughout fiscal 2026, but it probably tells you and it paints you the picture that the business has likely bottomed in the most recent quarter, also in the most recent year, and you'll likely continue to see moderate tick ups in their business as this company continues. And anytime you have a turnaround business that is actually beginning to start their turnaround, that is usually when shares react pretty nicely. You also had that reaction in the after hours. Now, in terms of their divisional revenues, I mean, things don't look great. They certainly look worse in some geographies compared to others. You have North America, which remains their largest segment, down about 11% on a total basis, down to $4.7 billion. Last year at the same time, you were at about $5.3 billion on your North American side. Your footwear is declining the fastest there, down about 13% year over year. In Europe and Middle East, down about 9%, as the apparel side declines the fastest there, down to about a $3 billion business in Europe and Middle East. In the all-important China region, you are seeing huge declines there, down about 21% on just the China business. And they were also asked about China specifically near the end of the conference call, and CEO and CFO did mention that they certainly do still believe in the China business. They do want to put emphasis on that side, continuing by increasing more innovation to the local population, creating more products that work for that sort of geography, also tailoring their marketing and their product market fit for the China region more specifically. So by no means is this company giving up on China. They've certainly fallen out of favor from the Chinese consumer, and they have a long way to catch up there. But because this company and the management really continues to believe in the China region and the story there, I believe they'll continue to emphasize that region as a big turnaround point. Certainly right now, the China business is really falling flat on its face, and that is showing up in their results. Also then in APAC, you're seeing the business decline about 8% as well. And then outside of the Nike brand, you also have Converse declining about 26% in the most recent quarter. I mean, I can't remember the last time I saw the Converse business actually grow from a revenue perspective. So this company on the Converse side has really been losing out for a number of years, in my opinion. I feel like the Converse brand really has fallen out of favor. There's really been no innovation on that side for as long as I can remember. And I think because of that, you're also seeing marketing for Converse not really hit, I think, the way it once used to. And so that's why you're seeing Converse sales decline nearly 30%. All in all, you're seeing declines across footwear, across apparel, and across the equipment lines for this company, and in all the different geographies, especially over in Greater China. Now, along with just revenue declines, the reason this company's profits are really struggling is because they're unable to mitigate those revenue declines with the cost of sales declining as fast as well. So you saw your revenues decline by about 12%, but your cost of sales only declined roughly 5%. And so your gross profit took a nearly 21% hit, despite your revenues declining just 12%. And so again, your gross profit went from $5.6 billion same time last year down to nearly $4.5 billion. Your gross margin cut basically by 4.5 basis points as well, now down to 40.3%. On top of that, this company is spending more on demand creation. Now, for most companies, I would actually think that's a bad thing, but for a company and a brand like Nike, demand creation is really what gets their customers to walk into a Nike store or to walk into a Foot Locker and be inspired to buy their new Nike running shoes or new Nike basketball shoes, or be inspired by the next great athlete that they see on TV repping a Nike shirt. You don't just get athletes like SGA who won the NBA title, or Carlos Alcaraz who just won the Roland Garros. You don't get those athletes on the Nike brand for all too cheap. And so you do have to pay up for that. You also have to pay up for marketing and ads. And I think stories that they want to create around these athletes, I actually think that's the way to go for Nike. No different to how Netflix spends a lot on creating and producing content, and they spend a lot on building a lot of content in-house. I think what that is to Netflix is demand creation over at Nike. And certainly I think spending their way out of this sales decline and innovating out of this sales decline is, in my opinion, the way to go. That's what you're seeing this company do under Elliott Hill. It's not what you saw out of their previous CEO, but I think that's the difference this company needs. They're also looking to control their operating overhead, as that was down roughly 3%. So all in all, in the most recent quarter, your SG&A expenses were basically flat, considering the fact that you controlled your operating overhead. But because your gross profit declined about 21% and your sales and marketing basically flat, your operating profit basically went from about $1.7 billion last year to call it just $300 million in the most recent quarter. So again, you're running the business at a break-even pace, at least in the most recent quarter. But if you get the sales to tick back up over the next couple of quarters, or at least stop the bleeding as much, and you continue to spend on demand creation, well, things, in my opinion, will begin to turn around over at Nike and begin to look pretty good. You also had a jump in the tax rate over at this company, as last year, I believe they got some one-time benefits there that didn't reoccur, and so you had your tax rate jump as well. But all in all, your net income went from 1.5 billion down to about $200 million, down about 86% on the net income side. And then from a cash flow perspective, the company doesn't really break it down, but when you take a look at their shareholder returns, you kind of get the picture that, look, from their balance sheet, about $2.4 billion left the building over the last year, considering the fact that this company had pretty much no operating income, and they continued to pay about $500 million in dividends, also another $200 million in share buybacks. Well, now you start to see how cash is leaving over at Nike. You also had this company pay off their short-term debt, about $1 billion. They wiped that out, and so some of that cash also going over to that short-term debt side as well. And then all things considered, the inventories is an important figure on their balance sheet. That was relatively flat despite this company trying to aggressively move through some of those legacy franchises. The other thing is, on the conference call, Nike did mention they are slowing down the pace of their buybacks. Some of that is, of course, due to the fact that you have cash leaving the building, and this company during uncertain times is wanting to be prudent about their cash. They also have that dividend, which continues to increase roughly 6% year over year. So I believe they don't want to pull back on the dividend, which I think is the wise thing, and they'll likely pull back on the share buybacks, at least in order to go through some uncertain times while they have the business pulling back as well. Now, in terms of the technicals, things again don't look great over at Nike. They haven't been looking great over the past number of years. This company has been locked in a downtrend since really all the way back in October of 2021. Before that, you were locked in a multi-decade uptrend that did more recently break through. And so you now are in a pretty steep downtrend, and you're continuing to be in that downtrend, making a pattern of lower lows and lower highs. Now, in the after hours, because of this pop, you are seeing shares once again resume back into this channel as it had popped out from this channel, and you're walking your way back up to the top end of the channel. If this downtrend continues, well, you'll likely see a rejection somewhere here in the mid 70s, and you'll likely once again continue back in the downtrend. The way to know that this downtrend is over, you want a decisive breakout above your channel, in fact above the previous set of highs here at $80. If you can get that breakout, that's your sign number one. And then the other sign is you actually want to backtest back into this channel somewhere in the mid to low 70s. And once you get that backtest and confirmation, that is probably your time where shares of Nike have likely bottomed and once again beginning to create a new uptrend at that point. So you want to wait for this breakout from this downtrend, especially as a conservative investor. You don't want to be caught buying the dip in a downtrend so steep. Now, with this downtrend, you do get pops like this, like you are getting in the after hours. But in my opinion, to be a more conservative and safer investor, you should probably wait for the breakout, wait for the backtest. Once you get that backtest, you buy it on the backtest right here in the mid 70s. Certainly possible we do get a pattern like this beginning to play out, considering the fact that you have this business now bottomed in this most recent quarter, and you'll likely see a resumption in the uptrend for at least the business. And so that could also signal an uptrend beginning in the stock as well. Again, I would wait for the confirmation, wait for at least a backtest to the top end of this range, or else you might get caught continuing to buy the dip in a stock that continues on dipping. That was my take on shares of Nike Incorporated. One I do like for the long term, certainly going through a number of headwinds in the most recent quarter. I think they have the management in place. They certainly have the cash in place to continue to spend on demand creation, continue to sign great athletes and tell great stories and put out hopefully great products surrounding those athletes as well. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening. I'll catch you guys in the next video.